Hi, I'm Mark Wester. Welcome to June quarter update for our market and portfolio update. Just as a reminder, we're going to be doing these each quarter going forward. And on this one, given what's been happening in the markets, I thought I'd actually just go back to the beginning of the year and work our way through. So we'll be covering a 6-month period rather than just the quarterly period. Obviously, the inflation genie is out of the bottle. Central banks are responding, but will they crash the economy? China is slowing down. What impact is that going to have? Obviously, the Ukraine war is having a huge impact on energy prices and energy supply. And then we'll just finish off with how the portfolios are travelling through this period. So from a macroeconomic perspective, the important things are always global growth, inflation, jobs and interest rates. So inflation is going to shape the landscape for a while yet, and the interesting thing about inflation is it's been pretty much missing in action for quite a while now. So kids, you might have to ask an adult about that, because we lived through that in the 70s and 80s, and we'll get to that in a minute. So inflation is pretty high throughout the developed economies and emerging economies, but as we can see here, inflation hit 8.6% in the US. New Zealand's not far behind on 7%. Australia, UK, and so on are booking pretty much the same numbers. And what we can see in this next slide is that the central banks are well and truly trailing behind the curve in terms of responding. The US is only at 1.75%, trying to tackle an 8.6% inflation rate. New Zealand 2%, trying to tackle a 7% inflation rate. Australia, the same story. Australia's an interesting story because it's only more recently come to the party in terms of acknowledging that the inflation genie is out of the bottle and they have to respond. Up to a few months ago or a few weeks ago, they were actually saying it was all under control and there was no need to put the accelerator down on raising interest rates. So global growth, up until a few months ago, we were projecting pretty solid global growth through. If you can see there for the US, they were looking at a 4% growth rate for 2022. That's that's a pretty strong growth rate for the largest economy in the world. The other economies, developed economies, were actually booking pretty strong growth rates as well, and that was off the back of pretty loose monetary conditions and low interest rates. But as we can see, the stories changed quite quickly in terms of growth. The US booked a minus 1.6% growth rate for the March quarter this year, and as we can see, the most recent growth rate for the New Zealand economy for the March quarter is minus 0.2%. Not huge, but as we can see from that previous graph, it's certainly turned a corner in terms of where people might be thinking growth is going. So inflation is the story of the day. It just took off through the late part of 2021 and, as we know, through 2022. And as we can see from this graph, this is the US inflation rate reaching 8.6%. That is an absolutely huge rate. And so, as we've said before, the genie is well and truly out of the bottle. The drivers for this have been energy prices pushed up by the war in Ukraine, supply chain problems from the pandemic, lockdowns in China, which has been a huge supplier of goods and services throughout the world, and in fact been a source of disinflation for developed economies importing these cheaper goods. And then, of course, the other big one was the central bank response to the pandemic, where they printed trillions and trillions of dollars of money. So you've had all of this money sloshing around developed economies, chasing goods and services, and this is obviously pushing prices up. So the inflation genie is well and truly out of the bottle. So what does that mean? So it means that the central banks are having to respond really quite strongly now. They're still at quite low levels in terms of their official cash rates, but as we can see from the US Fed funds rate, it's shot up from emergency settings that we had from the GFC of about 0 to 0.25%. It's actually pushed up to 1.75%, and the projection is that they're going to keep moving through that through to close to around 4%. So the last time we actually saw inflation where it was a huge problem like this was back in the 80s, 70s and 80s, and that was, a lot of that was attributed to the oil crisis and so on. And it took Paul Volcker, who was the US Federal Reserve Chairman back in the late 70s and 80s, pushing up interest rates and actually limiting the growth in money supply to actually get inflation under control. And what happened was the US and the world actually went into a recession then, but it was pretty much a necessary step to get inflation under control then. And so what we're thinking is, are we going to have to hurt the economy to get inflation under control again? So jobs. So the other thing that's been occurring is we're starting to get really strong wage growth. So what we're seeing at the moment is historically low levels of unemployment in developed economies. For example, we're getting 3.2%, 3.4%. And normally any level of unemployment below 5% historically has always been inflationary. And why it's an issue is we start getting skill shortages, and to attract the right sort of skills and people, then obviously employers start offering higher wages. Employees understand how valuable their skills are, and so they start asking for higher wages and so on as well. So this is a big factor that central banks and governments are really concerned about, because the thing that keeps central bankers and policymakers awake at night is this issue of this wage price cycle. So what that means is that as wages go up, that pushes prices up because these wages are obviously an input cost to the goods and services that are offered. The consumers, of course, are the wage earners, and with that sort of inflation, they ask for more money to compensate for the rise in those prices. And so that horrible wage price cycle or spiral is what keeps the central bankers awake and really concerns them. So it's that, and from there, what they're trying to battle is actually inflation expectations. And because if you expect prices to go up, your behaviour reflects that. And so what they're trying to really battle this wage price spiral and also battle inflation expectations. So more lately, Jerome Powell, the current Federal Reserve Chairman, he's been channeling Paul Volcker a bit, because he's really talking up the prospect for much higher interest rates and much tighter monetary conditions. And why do they need to do that? Because if you can see this graph here, that the US Federal Reserve's balance sheet, or how much money they have printed and pushed out into the economy, has gone from about $600 billion prior to the global financial crisis back in 2008 to $9 trillion US at the moment. And so that's a huge injection of cash and money supply into the economy, and that's what's been pushing inflation along, one of the factors that's been pushing inflation along. So now the US Federal Reserve is going from quantitative easing, or printing all of that money and pushing it out into the economy, to quantitative tightening. And what they're trying to do is actually drain the liquidity from the economy and increase borrowing rates for long-dated assets and mortgage rates. And what they're hoping is that will stymie or halt the demand for goods and services. Less pressure on those goods and services means that the vendors of those goods and services will actually have to stop raising prices, or actually in some cases drop prices, and hence obviously kill off inflation. And more importantly, what they want to do is actually kill off those inflation expectations. So rather than selling assets or selling assets off that balance sheet, what the Federal Reserve is going to do initially is actually not renew those assets. So whenever a 10-year bond that they bought as part of the process to combat the downturn from the pandemic, they were buying bonds to pump money into the economy to support it. They used to replace that when that matured. They're not going to do that now. So from June 1, they've actually been letting $47.5 billion US in Treasury bonds just run off and mature without replacing them. By September, they will be increasing that amount to $95 billion. To put that in context, that's about half of New Zealand's GDP every month that they will be doing there. Why is that important for the globe and us? Is because all of this, with the US being the largest economy in the world, all of this trickles down and impacts right through to mortgage rates here and inflation expectations. And so what does this mean for markets? Well, we've pretty much seen the result of that. The markets have, back in 2013, when Ben Bernanke announced the tapering program after the GFC, we had the famous taper tantrum. Well, you've seen a sort of a much more extended version of that, and the increasing interest rates have actually meant that the market reaction has been quite negative, and in fact the share markets, the global share markets, have officially gone into a bear market. That means more than a 20% downfall, and we've seen a big sell-off on bonds, or as we know, when bonds sell off, they actually increase in interest rates. So we've seen the US 10-year Treasury or their 10-year government bond actually go from about 0.5% to 3%. In New Zealand, the 10-year bond has gone from 0.5%. It actually hit 4% before it's retraced a little bit, but it's currently sitting around 3.6, 3.7%. And that's actually meant a massive fall in the value of those bonds when those interest rates rise like that. So with the market reaction to all of this, it's pretty easy to see has been massively negative for a lot of asset classes, and we'll get to that a little bit later in terms of how the portfolios have travelled through this and how we've seen other investors actually cope with this. So the second largest economy in the world is slowing for a number of reasons. China lowered their forecast rate a few months ago to 5.5%. It's pretty clear they won't get anywhere near that. It's probably going to be closer to 4%. And the hurdles they've been facing there, they've had big problems with their property developers. We saw the Evergrande debacle. They've been clamping down on tech companies, although that's loosening off a little bit now, and they've had problems with non-bank debt as well. So a combination of these, and then when you combine it with the fact that they've had to lock down these massive cities in Shanghai and Beijing, you know, that's really having an impact on their growth. The other big issue, of course, that we're seeing through China slowing is, of course, further problems with supply chains, because when Shanghai locked down, the number of ships waiting outside the port to load up increased massively. We saw a 30% increase in ships waiting outside the Shanghai port in 1 month, you know, obviously it's impacting the ability of factories to open, produce goods and ship them offshore. So that exacerbates the supply chain issue. So you've got a double-edged sword of China slowing, which actually lowers the impact of global inflation, but it increases the problems with supply chains, which have caused inflation. So you've got a bit of a double-edged sword going there. So higher interest rates, as we said, have been negative for both growth assets and bonds. And so how have the portfolios gone? Well, the portfolios are actually performing quite well. All of the individual components have performed exactly in line with what our expectations are and the conditions. And so what we're seeing is that the portfolios have actually had what we call a lot lower downside capture. So while equity markets and bond markets have fallen quite a lot by historical standards, the portfolios haven't fallen anywhere near as much. And that's as a result of effective diversification, both within each asset class and across asset classes. And so it also is a result of the work we've been doing through the last 5, 10, 15 years around different types of investment vehicles like multi-strat funds and so on. So these sorts of solutions obviously are much more aligned in terms of our clients' objectives, and so that's what we're aiming for through cycles like this, is that we want a much more even even outcome. We don't want to be banging down and then banging up, and because that increases uncertainty for investors in terms of what they're trying to achieve. So on the equity front, we've got the diversification has worked well because we've got domestic, international and emerging markets, and then that's combining with cash and currency, fixed interest, and as I stated before, these multi-strategy funds. And so that has produced a much smoother outcome through this period for the portfolios. And when we look at something like the International Equity Fund, it has over 5,000 securities, and it doesn't have anywhere near as much concentration as, say, the indexes. So that's a big outcome from the current downturn, is that investors have found that rather than being the gold standard in diversification, indexes actually have a lot of concentration in them. So for example, the S&P 500, only 6 stocks make up about 25% of that index. So that's clearly not really very good diversification. The types of core international equity solutions we have in the portfolios are much better diversified than that for exactly that reason. So we're aiming to avoid these concentration risks. So that means during periods like this, we don't get such extreme events. And that's working really well in the portfolios, as is the combination of the different classes of assets and so on. And what we've found too is that a lot of investors out there not using these solutions have found that they've ended up in these concentrated positions that aren't particularly well aligned with their objectives, especially if they're long-term investors, trying to achieve certain objectives over 20, 30, 40 years. And so we've really got to work hard to make sure that you get proper alignment with the types of assets you use and the objectives you've got. So the portfolios have been travelling well through this period. So that's it from me. Thanks for joining us. We'll be doing quite a number of different types of videos on different topics, because we want to flesh out some of the areas that I've covered today. We want to flesh those out in more detail. So thanks for joining me, and look out for those other videos. Bye.